Hello everyone, my name is Nitin Nahar. I welcome you all on behalf of JK Shah classes to this IDT RTP CA final May 2022. Now, revision test papers basically contain about 20 questions. Let's go through all these questions one by one. If you see the first one, it is a MCQ related case study based question. Now, in a MCQ based case study related question, your approach should be very clear. There will be some tricky areas in the case study based question and some easy ones as well, which you can solve very quickly. So I would always recommend to first read all the questions related to MCQ and then read the MCQ so that you are focused on getting that particular answer which the institute requires. Let's go through the case study questions as to what they are asking us, then we'll read the case study. Okay. It says based on the following scenarios given below, choose the most appropriate answer for question 1 to question 5. What all have they asked us? First one, gross GST liability of Mumbai head office Zoom Air. That means we need to focus on gross GST liability only for Mumbai office, not for anyone else. Fine. And it is for the month of January. All kinds of credit available. That means it could include something related to TCS. It could be something related to TDS under GST. It could also be normal input tax credit. All kinds of credits available for Mumbai HO of Zoom Air for setting off against GST liability. Setting off, let's see what all question would say. Assuming that the customers in point 1 in case scenario are registered customer and all the other conditions are complied, the ITC available to the customers. So what would be the ITC available to the customers? Okay. Then choose the correct answer in relation to transaction between Haryana office of Zoom Air and Amazing Private Limited. The services are in nature of OIDAR and Amazing Private Limited has to pay 90,000. Sale of advertisements space is a deemed sale, 45,000. Zoom Air is required to pay 90,000 or Zoom Air is required to pay CGST of 45,000, SGST of 45,000. Full credit will be available to Amazing Private Limited. Okay. And the last one, Supertrip India purchases 1,000 air tickets in bulk for 1,000 per ticket from Zoom Air and provides booking of air ticket facility at its electronic portal to its customers on its own account. Okay, that means Supertrip India is purchasing 1,000 tickets and thereafter they are going to sell it at the prices which they want to. Supertrip India was able to sell only 800 tickets for which it received an amount of 15 lakh. As per the agreement, the remaining 200 tickets purchased by Supertrip India from Zoom Air lapsed and the amount was forfeited by Zoom Air. Obviously, Zoom Air is not going to return because it has sold 1,000 air tickets at 1,000. Rate of TCS 1%. Choose the correct statement. Supertrip is liable. Supertrip is acting as an agent. Supertrip shall be liable to pay this much. Zoom Air is liable to pay this much. Supertrip shall pay 157 and Zoom Air shall pay 180. Now, if you see the last one, last one can be solved even without going through the balance one. This is an independent part. See, Supertrip has purchased 1,000 air tickets at rupees 1,000. So that means Zoom Air will charge Supertrip. 1,000 into 1,000 would come to 10 lakh. 10 lakh into 18%. Zoom Air's liability will be 1,80,000. Zoom Air has to discharge 1,80,000 because 10 lakh worth tickets have been sold by them. Now, Supertrip further sells it to customers for rupees 15 lakh. Now, when they sell it for 15 lakh, 15 lakh into 18%, 2,70,000. See, Supertrip will charge to customers, but they will also get input tax credit of whatever Zoom Air has charged. That means their ITC will be 1,80,000 and output will be 270. So Zoom Air will first discharge 1,80,000 and Supertrip has to discharge 270. Out of that, 180 will be ITC, 90,000 will be required to be discharged. Now if we see, here we get the answer. Supertrip shall be liable to pay 90 because 270 minus 90, they will be able to take input tax credit, and Zoom Air will be liable to pay 1,80,000. Forfeited tickets would anyways be of no use because you have already discharged GST at the first leg on that, because 1,000 into 1,000, that's already discharged. So this is Zoom Air's liability and this is the liability of Supertrip. So you got one answer without even reading the case study. Sometimes in the case study questions, it is also possible that you are able to solve two questions without even reading the case study further. That's where you need to save your time. If you find one case study type question where one part will consume too much time for that 2 marks, then please move forward. Focus on other areas. You need to fetch marks wherever it is available, and somewhere where we find 2 marks but the calculations would be way beyond the marks which are allotted, then in that case you need to be smart enough and tackle it at the end rather than doing it at the beginning, because most of the students complain about one thing: lack of time in the paper. MCQ based questions is an area where institute would try to make you spend that time which you have. So be very careful in case study based questions. Now coming back, we have completed 5th part, but we are yet to see the other parts. 1, 2, 3, 4 we have just read. One is GST liability, gross, credits, then customers, how much ITC will they get, and this was a transaction between Haryana office of Zoom Air and Amazing Private Limited. We'll have a look at that. Now let's go through the case study based question with a clear mindset that we have to determine GST gross liability of Zoom Air. Plus one ITC related thing is there that we need to tackle. So whenever we are reading a sentence, we need to tackle those two things. Let's see. Zoom Air is an airline company, fine, operating domestic as well as international flights. The head office of Zoom Air is in Mumbai. Company has obtained registration in each of the state from where it operates flights during the month of January. So that means this is January data. We have to compute it for January. The following transactions were undertaken. Zoom Air sold air tickets worth 5 lakh during the month from its head office, and the breakup of airfare is as follows. So basic fare 4 lakh rupees excluding GST, passenger service fee and user development fee inclusive of GST 1 lakh rupees. You are very well aware that passenger service fee and user development fee a airline collects on behalf of Airport Authority of India, and in such cases the authority for which it is collected, they will have to pay the taxes. If it's a private airport authority, then they would have to pay. If it is AI, then they will have to pay GST to government. Airline is only collecting it on behalf of the airport operators. Let's have a look. Both PSF and UDF are statutory fees which are required to be collected by airline as per government directions and authorization given to airline. The aforesaid amount is inclusive of 18% GST. PSF and UDF are remitted by airlines to airport authority. Further, the amount of PSF and UDF is separately disclosed in the invoice issued to customer by Zoom Air along with applicable GST. Fair enough. the airport authority pays 5% of PSF and UDF inclusive of GST amount collected as collection charges to the airline on which GST is applicable. Now, out of this 1 lakh, 1 lakh into 5% is what Zoom Air gets as commission. Now, on this also GST will be applicable. Now, let's see the rate of GST which is given. GST is applicable on the aforesaid case scenario at 18%, excluding CSCI bifurcation for the sake of simplicity. So 18% is what we will take everywhere. Fine. So that means, can I say on this 4 lakh rupees basic fare, 4 lakh into 18% has to be discharged by Zoom Air. This will be their output. So I am just mentioning it as 72,000 output of Mumbai office. Then 1 lakh into 5% they get commission. This again into 18%, that is 900 rupees will be output of Zoom Air. Fine. There is no levy of PSF and UDF on tickets booked by Zoom Air for its own crew or other employees. Zoom Air head office has collaborated with Supertrip India, an online travel portal for providing services to customer by way of booking air tickets through its e-commerce platform and registered under GST in the state of Maharashtra. During the month, Supertrip India booked tickets of 2 lakh, that is base fare, excluding GST, PSF and UDF to customers of Zoom Air. The amount was remitted by Supertrip after adjustments as per GST law in terms of the TCS at 1% or 0.5%. In addition to the aforesaid amount, Supertrip charges commission at the rate of 5%. So, we have some information here. See, 2 lakh rupees worth tickets have been sold on the platform. So, 2 lakh into 18%, this 36,000 will become output for Zoom Air. Now, on this 2 lakh, there will be 1% TCS. This TCS will be a credit for Zoom Air. So while answering TCS credit question, we'll have to take this into account. See, Supertrip is charging commission 2 lakh into 5%. 2 lakh into 5% would be 10,000. On that 10,000, they will be charging us 18% tax. That is 1800. And for us, this will come in ITC. Be very careful. In one particular transaction, we found 3 things. 1. Output which we need to discharge, 2 lakh into 18%. Second, 2 lakh rupees into 1% TCS will be available to us as credit. Third one, 2 lakh into 5% commission. This is the commission charged by Supertrip. And if commission is charged by Supertrip, they will charge us GST. We will get a ITC of this. That means 3 informations from this one point. Very important point. Okay, let's take it forward. Zoom Air head office charged 100% cancellation fee from customers for bookings made for prior months. The amount of cancellation fee was 1 lakh inclusive of GST. Instead of actually collecting the cancellation fee from customer, such amount was adjusted against booking amount and GST discharged at the time of initial booking. Careful, this is a very important line. If GST is already discharged at the time of initial booking, then in that case, we are not required to discharge GST again on this. Fine. However, PSF and UDF amounting to 10,000 charged from customers were refunded. Okay. Nothing will come out of this in output or ITC. Fine. Zoom Air provides gifts in the form of air tickets to 10 of its employees for an amount equivalent to 60,000. People, Gift up to 50,000 is exempted. That's not considered as a supply as per schedule 1 of section 7. But here it is 60,000. That means you will have to discharge GST on this. This will form part of output. 6 lakh into 18%. 6 lakh into 18% would come to 1,08,000. This will also form part of output. Correct? Okay. Zoomer has a corporate tie-up with Welcome Hotel in Rajasthan for stay of its crew members. For January, hotel issued invoice of 5 lakh in the name of Zoomer Mumbai, Rajasthan Hotel, charging Mumbai head office. The tax will get buried in the state, because if you book a hotel in Rajasthan, they will charge C plus S of Rajasthan. The moment they charge C plus S of Rajasthan, you would not be eligible to take credit in Maharashtra. That means here ITC would not be available. And then Haryana office of Zoomer has provided services by way of sale of online advertisement space to Amazing Private Limited. These are domestic transaction. Both are in Haryana. So OIDAR provision would be applicable in case of import where the recipient was in India, supplier was outside India. So this is a case where both are in India. Haryana office has charged Amazing Private Limited for promotion of Amazing Private Limited's products. The amount charged by Haryana office is 5 lakh. This is a simple case. 5 lakh GST would be applicable at 18%. Both are in Haryana. So therefore, it would be a simple case of C plus S. All the amounts are exclusive of GST. The opening balance is 0. All the conditions of ITC have been fulfilled. No other outward supply and inward supply for January month. All this is normal. And in case of cancellation of tickets, the airport authority and Zoom Air have entered into an agreement that PSF and UDF related to adjustment shall be finalized at the end of the financial year. That means we don't have to do any adjustment for January month. Further, separate invoice shall be issued for carrying out adjustment in the books of accounts. That anyways will have to be done at the end of the financial year, not now, for cancellation of tickets. Now coming to gross GST liability for Mumbai head office Zoomer. Let's see. Well, Mumbai head office, one is this 72,000, 900, 36,000 and 1,08,000. These are the 4 liabilities. Now if we add this 72, this will come to 1,08,000, 1,08,000 plus 1,08,000, 216, 216, 900. So the answer will be D, 216, 900. What you charged on tickets, then commission, then booking through Supertrip, and finally free tickets. Clear? So these 4 will give us the answer. Okay. Then it says determine the kind of credits which will be available for the month of January. See, you will get credit. Hotel you will not get ITC. You will get credit of this TCS in your eCash ledger 2000 plus 1800. So 2000 plus 1800 would come to 3800. So here the answer will be 3800. Correct? Now let's see the third one. This is Supertrip ITC and this is the TCS amount. Assuming that the customers in point 1 of the case scenario are registered customers and all the conditions are satisfied, determine the ITC available to customers. Let's see what was point 1. Now if you see point 1, This was point 1. Zoom Air sold tickets worth 5 lakh. 4 lakh into 18%, the customers will get ITC, assuming all the conditions are satisfied. Plus, passenger service fee and user development fee is inclusive of GST. That means out of this 1 lakh, we'll have to find the GST amount. That will also be available as ITC, because question is saying all other conditions are satisfied. You don't have to worry whether airport authorities have billed it correctly, whether GST was shown separately, because the question itself is saying if all the conditions are satisfied. So the credit available to customers will be 4 lakh into 18%, which comes to 72,000, and 1 lakh divided by 118 into 18. So 1 lakh divided by 118 into 18. Now this will come to 15,254. Now if I total this will come to 87,254. And the credit available to customers will be 87,254. And one more request, in real scenarios, you would have found that air tickets are subject to 5% GST. Please don't write that in the examination. In the examination, question would provide the rate. Please apply that. Okay. Then choose the correct answer in relation to transaction between Haryana office and Amazing. That was that OIDAR service, but it was both were in Haryana. So obviously IGST and this cannot apply. Deemed sale as per schedule 2, no, it's a simple transaction of supply. So the winning answer would be CGST 45, SGST 45, and Amazing Private Limited would get full ITC on this particular transaction. They would not lose even a single rupee on this transaction. Okay, so you understood. Some would be very simple. You'll be able to tackle them even without reading the balance question, and some will be conceptual like this one, and some would involve working. I mean, gross liability would involve you to read everything. This type of question takes maximum amount of time. But while reading the question, if you can just note down O and ITC, it would become very easy for you to arrive at the answer. Yes? Okay, let's move forward. See, now here near the question the answers are available. Anyways, we'll still go through these questions as well. The good part about these questions was answer was not available, at least in a bold format. But here question 6, the answer is already available. Let's go through this question number 6. Quality Bells Private Limited, registered in Chennai, Tamil Nadu, provides the following outward supply. So there's intrastate supply, interstate supply, supply of goods procured from China, directly from China to UK without entering into India. This is negative list transaction. High sea sale, endorsement, again it's a negative list supply. That means there are two negative list supplies and there are two inter and intra. What have they asked us? Aggregate turnover. See, anything which is there in negative list is not at all a supply. The moment we say it's not at all a supply, it cannot be added in our aggregate turnover, because aggregate turnover would be taxable supplies, exempt supplies, interstate supplies, export of goods or services. These four things are included. Anything other than that is not. Sir, but exempt supply can include non-taxable supply. See, exempt supply can include non-taxable supply, meaning alcoholic liquor, 5 products, those will be included. But negative list is not at all a supply. Negative list is considered only for the purpose of that E by F calculation. Which E by F, sir? E by F calculation which we do in input tax credit chapter for apportionment of ITC. That's the place where we use this. Otherwise, we don't use negative list transactions. So this is not at all a supply. As it is not at all a supply, it can never become part of aggregate turnover. So my aggregate turnover would be 40 plus 15 plus 30 plus 10. These four taken together, 55 plus 40, which will come to 95 lakh. This will be the answer. Okay. Let's see the next one. State which of the following statements are correct relating to warehousing under customs. People, this question being given in the RTP is an indication that warehousing under customs is now part of syllabus. See, till November 21 exams, warehousing was not part of syllabus, but now warehousing under customs is part of syllabus. I have spoken about this in earlier videos as well, uploaded on YouTube, and also the amendment lecture covers warehousing chapter entirely. So please don't miss out on that amendment video and don't miss out on this warehousing chapter under customs. Okay, let's see. Special warehouses are not under physical control of custom authorities. It's a wrong statement because special warehouses are actually under the control of custom authorities. The importer of warehoused goods is required to submit a bond twice the duty amount. Wrong. This is thrice the duty amount. In case of imported goods used by any EOU, the warehousing period for capital goods is still ex-bonding. Ex-bonding is still removal. And for goods other than capital goods, it is still ex-bonding. Both are correct. Inputs and capital goods stored by an EOU can be removed whenever they want. And when they remove, only till that time it is considered as valid. So no interest would be applicable till that time. In case of imported goods for use in an 100% EOU, the warehousing period is 1 year. This is a wrong statement because it is till clearance. Okay. No drawback of import duty will be allowed in respect of if they are used after their importation. So wearing apparel, yeah, obviously wearing apparel you don't get duty drawback if it is after use. Tea chest, again you don't get. Silver utensils are allowed. Then exposed cinematographic film, again. So 1, 2 and 4. For these 3 it is not allowed. Okay. Now if you see the 9th question, it's a question which involves us to do computation. Now it's not MCQ anymore. So 9th question requires us to calculate everything. Now whenever you find a lengthy question, I would always prefer to read the rates of GST, what they are trying to ask first, so that you are very clear as to what you have to do in the question. Let's start. With the help of the above mentioned information, compute gross GST liability. So we are not concerned about ITC in this. We are concerned about gross GST liability of Adityanath Private Limited for the month of August on outward supplies made during the period. Assume that the GST rate on outward supply of goods and services are 12 and 18% respectively. Careful. This is something tricky. Goods 12%, services 18%. Don't start applying 18% everywhere. Be very careful on this. Goods 12, services 18. Unless otherwise specified, ignore CSI GST for the sake of simplicity. No need to do CSI separately. Exports made by Adityanath Private Limited have been made to person other than distinct person and made by furnishing LUT, that is letter of undertaking, without payment of IGST. So exports are being made under bond or LUT. Okay. Now, so gross GST liability is the target, 12% and 18%. Now let's start. Now, Adityanath Private Limited is registered under GST in Uttar Pradesh. It is engaged in supplying 3 products: alpha, beta, gamma from the factory of Rampur. Alpha and beta are taxable. Okay, I'll just mention this here. Alpha taxable, beta taxable. Gamma is exempt. Gamma is exempt. Besides, it also supplies cigarettes from factory located in Kanpur and owns a petrol pump in Lucknow. It is also engaged in supply of certain services. Fine. The following supplies are made. Okay. Now, let's start. Supply of product alpha. Alpha is taxable. So, 50 lakh into 12%. This comes to 6 lakh. Correct. This will be considered as output. Anyways, we have to only calculate output. So, we can just mention this. Supply of gamma. Gamma is exempted. So, nothing will come. Then supply of management consultancy services. This will be subject to 18%. So 50 lakh into 18% comes to 9 lakh. Renting of commercial complex to local traders. This is also taxable. Into 18% it's a service. Again 9 lakh. Export of beta. Export under bond or LUT. Nothing will come. Export of consultancy service including 5 lakh rupees received from Nepal based company, payment received in INR. They will also mention that this particular thing is approved by RBI because Nepal and Bhutan payments, which one will you prefer, Indian currency or Nepali currency? Indian currency. And that's the reason RBI has permitted INR, that INR is sufficient compliance when you are exporting to Nepal and Bhutan. So still it would be considered as export. Then sale of building excluding stamp duty of 2.5 lakh being 2% of the value adopted. Entire consideration is received post completion. Then again GST would not be applicable. Interest received on investment of fixed deposit. Again there is no GST. Then sale of shares of a public company, securities, no GST. Supply of cigarettes. Cigarettes leviable to 28% including excise duty. See, this 1 crore is including excise duty. So you'll directly charge on 1 crore because any tax other than GST and compensation cess is liable to GST. So this will be 28 lakh. Supply of petrol and diesel including VAT of 5 lakh rupees and excise duty 12 lakh 50. See, petrol diesel, it is liable to VAT and excise duty but not to GST. So GST computation will be nil. Amount received from Durga Das Private Limited, Uttar Pradesh. It has sponsored business exhibition organized by Aditya Private Limited. So Aditya Private Limited is the organizer. Durga Das Private Limited is receiving the sponsorship service. See, sponsorship service to a body corporate has to pay under RCM. As body corporate has to pay under RCM, our liability in this will not be there because Durga Das Private Limited will have to pay. Sponsorship service to a partnership firm or body corporate. Such partnership firm or body corporate is required to discharge GST. So our liability would not come in this case. Correct? Here the liability would be 0. Those are the transactions. Now if we just total this, 6, 18, 24, 24 plus 28, 52 lakh. Our output liability will be 52 lakh. This is what we have to pay to government. Correct? Clear with this? That's it, sir. That's it. We had to identify each of the cases. Okay. Let's see the 10th one. Let's move forward to the next question. Oh, if you see in the above question, wonderful. Now, in the above question, all other things remaining same, compute net GST payable. So, earlier they had asked us gross GST payable. We computed the output 52 lakh. Now they are asking us compute the net GST payable from e-cash ledger if Adityanath Private Limited furnishes the following additional information. So most of this information will be related to input tax credit, and we will have to tackle that input tax credit information. Correct? Okay, let's have a look. See this carefully. Let's see where all we'll get ITC. Now, consideration paid for repair of machine used in manufacturing of product alpha. Alpha was taxable, alpha and beta was taxable, gamma was exempted. By George Inc. of USA. Said machine was sent to George Inc. in August for carrying out repair. Now, repair is done outside India. You think. Repair done outside India. What would be the place of supply for this? Sir, if the repair is done outside India, then the place of supply will be outside India. Correct? Then in that case, here there would not be any GST payable under RCM because the place of supply for this transaction is outside India. But when you get this machine from outside India, custom duty will be applicable on repair plus to and freight and insurance. That will be applicable, but that information is not given to us, so we will not do any such computation. GST under RCM, no GST under RCM would be applicable, and George Inc. is not going to charge GST to us. There is no question of any tax on this. Fair enough. Life insurance premium paid by the company for life insurance of employees as per policy of the company. There is no legal obligation to provide such insurance. If there is no legal obligation, you will not get ITC. Okay, let's just check the GST rate also so that it helps us in computation. Let's see the GST rate. Assume that the rate of GST for all inward supply of goods and services are 12 and 18. That means people, goods 12, services 18. We need to be careful. Unless otherwise specified, ignore CSI for the sake of simplicity. Subject to the information given, all other conditions necessary have been satisfied. Turnover of last year 40 crore. Whenever they give you turnover of last year, either there is a government related service which we have received or advocate service, because that's the only purpose of giving last year turnover. Or whenever they say started business, these two things, that means advocate or government related service is there in the question. The input and input services for August are commonly used. That means we will have to do apportionment. Are commonly used for making all outward supplies unless otherwise specified. If something is for one particular thing, yes, otherwise everything will be common credit. No opening balance of e-credit because they have mentioned it as nil. So 12% for goods, 18% for services. Now let's come back. So first one, no RCM. Second one, life insurance. It is a block credit under section 17(5). Audit fees paid. Audit fees pays common credit. 6,50,000 into 18%. So 6,50,000 into 18 will come to 1,17,000. Then raw material purchased, including raw material of 1,50,000 which was imported from China. Basic custom duty 15,000, social welfare charge 1,500, IGST 19,970. People, this 29,970 you will get ITC, correct? And balance 850 is purchased within. So we will write 8.5 lakh into 12%. This is goods. This is where you need to be smart. Don't apply 18% here, otherwise the entire thing goes wrong. 8.5 lakh into 12%. Which will come to 1,02,000, and plus IGST, that is 29,970. This will also be available. Then transportation charges paid for transporting the goods. 4 lakh was paid to GTA registered in Uttar Pradesh, and 1 lakh for horse pulled cart. 1 lakh for horse pulled cart is exempt. Transportation of goods by road is exempt except GTA and courier agency. So 4 lakh will be taxable and we will have to pay under RCM because rate given is 5%. So see, we'll get ITC also. 4 lakh into 5%, that is 20,000, and I will just mention it that RCM liability will be 4 lakh into 5%, that is 20,000. See, there are 3 baskets: output, ITC and RCM. Output minus ITC plus RCM payable will give us the answer. So 20,000 is here. 1 lakh will be exempt because transportation of goods by road by any means is exempt. Okay. Telephone charges 4,25,000. So 4.25 lakhs into 18%. So this will come to 4.5 into 18%. This comes to 76,500. 4.25 into 18%, 76,500. Okay, then bank charges, obviously bank charges you'll again get ITC, 36,000. Then legal services only for product beta. That means this is something relatable to one product. So 3.5 lakh into 18%. Now 3.5 lakh into 18% comes to 63,000. Now 63,000 will be available as ITC to you. Correct, people? Yes. Obviously, you will get ITC on this fully. This is not a common credit. So all these are common credits. Audit fees, raw material, transportation charges, telephone, bank charges, all these taken together are common credit. But this 63,000 will be available completely because it is for beta. Beta was taxable. Alpha and beta were taxable. Gamma was exempted. So this you will get, and 63,000 you have to pay under RCM, advocate service. So here I am writing 63,000 RCM. RCM liability will be 83,000. Correct? Okay. Now that we have common credit available with us, let's do a total of common credit. Let's total it up. 1,17,000 plus 1,02,000, 29,970 plus 20,000 plus 76,500 and 36,000. This comes to 381,470. 381,470 is the common credit. See, common credit we'll have to multiply with E by F. Now to find out E by F, we will have to find out which is E, which is F, considering the 9th question. See this. We had seen supply of alpha, supply of gamma, export transactions. We had seen all this. Now let me just put a column here. What is E? What is F? See, taxable product is not E. It will be considered only as F. Gamma will be considered as E, plus it will also be considered as F. Because it is an exempt product, it will be considered as E plus F. Then management consultancy service, it is not E, it is a taxable transaction. Then commercial complex renting, again it will be only considered in F. Beta exported, again it will be considered only as F. Then consultancy service outside India, it is only F. Then okay, land and building, people be very careful. Land and building is valued at stamp duty value. So if I do 2.5 lakh divided by 2%, I will get Okay, I'll get 125 lakh. 125 lakh will be considered as E. 125 lakh will be considered as F. Be very careful. I'll not consider 250 lakh because stamp duty value is considered for the purpose of E and F. Then interest received on fixed deposit. See, this is not considered as E. This will come only as F. Then sale of securities. Sale of securities 1% is considered. So 2.5 crore into 1% will come to 2.5 lakh E, 2.5 lakh F. And supply of cigarettes. Here again very important point. See, supply of cigarettes, excise duty and VAT, these things are not considered as part of E and F computation. So these two have to be removed. So from 1 crore, you will remove 12,50,000. This will come to, cigarettes is taxable, right? So 87.5 lakh. It is not considered as E. And supply of petrol, diesel. People, petrol and diesel, GST is not applicable. We have not discharged output. So this will come in E as well as F. 80 lakh minus 1750 comes to 62.5 and 62.5. Now let's just total this up. Okay, one last one is left. 6 lakh rupees. RCM will be considered as E. It will also be considered as F. That will also be added. Obviously, RCM liability will form part of E and F because the other person is paying. See, what is the definition of E? Exempt supply plus supply where the recipient is required to pay the tax. Both will be considered as part of E. Now let's total this. 100, 225, 225 plus 2.5 plus 62.5 plus 6. This comes to 296. And the other one, 50, 150, 200, 250, 350, 370 plus 125 plus 10.5 plus 2.5 plus 87.5, 62.5 and 6 lakh. This comes to 664. So 296 lakhs and 664 lakhs. This will be my E and F. I can use this. See, output is 52 lakh and I have to derive my ITC. Now E by F, 296 divided by 664. See, if you see the calculation here now, I'll just write output from previous question is 52 lakh. Now I have to derive ITC and then add RCM liability. Correct. This will be my answer. Output minus ITC plus RCM payable. RCM payable I am already aware, it is 83,000 which is coming from this GTA service and advocate related service. ITC, see, ITC 381 470 into 296 divided by 664, 1,70,053. This is what is denied as ITC. Correct. You will not get ITC. So how much will you get as ITC? You would get 381,470. From where did you get this, sir? This one. 381,470 minus 170,053 which is denied. I am getting from here plus 63,000. Sir, from where did you get 63,000? This is something related to beta which is available as ITC. This will be available. So 63,000 is available. So if I do this computation, 381,470 minus 1,70,053 plus 63,000. My ITC available will be 274,417 and this figure I can put it here, 274,417. So if I do 52 lakh minus 274,417 plus 83,000. I will get the tax payable as 50,08,583. Are you clear with this? Now just to sum up, what did we do? See, first we derived, there was a question where we were told to derive output tax. We derived output tax. Then we were told to find out ITC. Now in ITC, we first figured out what was common credit. And we figured out that one thing is not common credit. And we also figured out where ITC itself is not available. Once we got a total of 381,470, then the major task was to find out E and F. How did we find E and F? E and F was simple for us because wherever we had done tax computations and export, that will come only as F, and anything else will come as E. And obviously anything which is exempt supply will also be considered as F. So we computed this and arrived at E and F. Then we use this E and F to derive our ITC, which is not eligible. Finally, we computed ITC eligible, subtracted with output and added RCM payable to arrive at our final answer. Clear with this? Yes? Solve it once before you see the balance, because this was something which was a major question in this particular RTP. Okay. Now let's see the 11th question. This is a place of supply question. Determine the place of supply in the following independent cases. Mr. Sahukar boards New Delhi Savai Madhupur train at New Delhi. Okay. Sahukar sells goods taken on board the train by him at New Delhi. In the train. So he is supplying goods in the train at Bharatpur during the journey. Now, people, you know that when goods are loaded on a conveyance, wherever they are loaded, that would be the place of supply. So, goods were loaded at New Delhi, the place of supply will be New Delhi. Section 10 of IGST Act. Then, Vidyut Private Limited imports electric food processors from US to its store in Uttar Pradesh. This is section 11. It is being imported in Uttar Pradesh, so the place of supply will be Uttar Pradesh. Fine. Then Atmaram, unregistered under GST. Careful, whenever they mention unregistered, registered, remember section 12, registered, unregistered is used at various places. A manager in a bank is transferred from Bareilly, Uttar Pradesh to Madhya Pradesh. Mr. Atmaram's family is stationed in Uttar Pradesh. He hires Gokul Carriers of Lucknow, Uttar Pradesh to transport household articles from Kanpur to Bhopal. People, transportation of goods. Transportation of goods. If it is provided to an unregistered person, then the place of supply will be where the goods are handed over for further transportation. Where is it handed over? It is handed over at Kanpur, and the place of supply will be Kanpur, that is Uttar Pradesh. Okay. Bholunath, a resident of New Delhi, opens his savings account in New Delhi branch of Best Bank after going through KYC process. That means address is available on record. He goes to Amritsar for some official work and withdraws money from an ATM, and free limit transaction is over, so withdrawal charges are levied. Place of supply will be New Delhi. Because he is a resident of New Delhi, the place of supply will be New Delhi. Clear? Okay. Let's see the next one. Chandra is engaged in supply of certain goods in the state of Punjab from his factory located in Punjab. He is not yet registered under GST As his turnover is moving towards the threshold, he approaches the tax advisor regarding applicability of GST on supply made by him. His tax advisor is unable to determine whether supply of goods by Chandra amounts to supply under GST and also the classification of said goods. So tax advisor is not able to help. He advises Chandra to apply for an advance ruling. Okay, that means the question is based on advance ruling in respect of the said issues. He told Chandra that advance ruling would bring him certainty and transparency. Agreed. And would avoid litigation later. Agreed. Chandra agrees with his views but has some apprehensions. Let's see what is the problem faced by Mr. Chandra. In view of the information given above, you are required to advise Chandra for the following. Let's see what we have to advise. The tax advisor asks Chandra to get registered under GST law before applying for advance ruling, as only registered persons can apply for the same. Whether it is necessary to get registered? The answer is no. In fact, one of the basic matters for which advance ruling can be taken is whether I am liable to register. So obviously the law does not have a criteria that he has to be a registered person. A registered person or any person would be allowed to make a application. That is there in the definition of applicant. So this is something which is wrong, and we'll have to advise him that no such condition is there in the provisions. Can Chandra seek a advance ruling for supply of goods and classification? The answer is yes. Both the matters of supply, whether it is a supply and classification, are considered as matters for which advance ruling can be taken. Place of supply cannot be taken, otherwise the law is providing opportunities. Chandra is doubtful whether he can seek advance ruling in relation to activity or transaction already being undertaken. Is this doubt correct? No, his doubt is not correct. You can in fact take it for any matter. Already undertaken, allowed. Obviously, it is allowed to take a advance ruling for something which is to be undertaken or already undertaken. The law is very clear regarding this. Both the things are eligible for being applied for advance ruling. Chandra is apprehensive that the authority for advance ruling may take years to pronounce the ruling. The answer is no, his view is not correct. 90 days. 90 days. It is one of the fastest. People, provisional assessment, I wouldn't have given them an advice on provisional assessment, because yes, provisional assessment takes good amount of time. But when you talk about this particular case, obviously 90 days is what is given as time, which is very fast. Okay, let's see the next one. Mr. Aryant is engaged in supply of taxable goods and is registered in the state of Orissa. A demand notice of 50 lakh is served to him on 5th April. On 10th April, despite having knowledge of the said notice, Mr. Aryant transfers his ancestral property located in Punjab in the name of his wife Soma for 2 lakh rupees without taking permission from the GST authorities. The value for the purpose of stamp duty was 80 lakh. This is for inadequate consideration. You are trying to transfer the property to safeguard yourself. Subsequently, he filed a reply saying that he would not be able to pay the amount as his financial situation is distressed. Determine the validity of act of transferring the property to his wife. This will be a void transfer. Section 81 clearly provides that if you transfer it without adequate consideration and officers were not aware, in that case this transfer will be regarded as void. And if this transfer is regarded as void, you have that property, you will have to sell that, or even recovering proceedings can be initiated against Mr. Aryant. Clear? Simple question. Now, prosecution, arrest and bail implication. All the three have to be determined. Prosecution, arrest and bail, if any, in respect of the following independent cases. Ashuram fraudulently availed ITC of 200 lakhs without any invoice or bill. He is yet to utilize it. See, this is a non-cognizable offense. Fraudulently availing ITC, non-cognizable, not more than 5 crores because it falls under that ABCD criteria. Non-cognizable offense. And the punishment for 200 lakhs. See, the punishment for 1 crore to 3. This will be 1 year. And is arrest possible? No, arrest is not possible. Arrest is a preventive arrest which is not possible, and it is a non-cognizable and bailable offense. Bahubali fraudulently avails refund of tax of 550 lakhs. This is more than, that means jail term will be up to 5 years. Again, it's a non-cognizable offense because cognizable offenses are only A, B, C, D. First 4 offenses in section 132 are considered as cognizable if it is more than 5 crore. Otherwise, all these are considered as non-cognizable. So, arrest, obviously, no arrest possible because arrest is also possible in those cases, but if it is more than 2 crores. So, again, it is a case of no arrest and it's a bailable offense. Then, knowingly supplies false information. The amount of tax involved is 250 lakhs. Again, it's a non-cognizable offense. Up to 3 years can be the jail term. No arrest. And again, it's a bailable offense. And the last one, collects 650 lakh as tax in January but has deposited only 50 lakh. This is wrong. 600 lakhs. It falls under ABCD criteria. It's a cognizable offense. Up to 5 years. Arrest is possible, yes, with the approval of commissioner. Only with the approval of commissioner, and it's a non-bailable offense. This is how you'll have to structure your answer. 4 columns, whether cognizable, non-cognizable, what is the imprisonment, whether arrest is possible, and mention that with the approval of commissioner, and lastly whether it is bailable or not. 4 columns, structure, and your answer is complete. Clear? Okay. And see this last one, it is committed for the first time, because if it was a subsequent offense, this arrest would have been possible, because for subsequent offenses arrest is possible. Clear? Okay. Now let's see the next one. Mr. Ajit Basu, Director of Dharma Private Limited, Kolkata, for past 5 years. He resigned on 1st April of the current financial year. He receives a notice of demand on 5th July for recovery of tax dues of Dharma Private Limited. Private Limited company, a public limited company, director might not be responsible. For a private limited company, he is responsible. Pertaining to preceding financial year, as dues cannot be recovered from the company owing to poor financial condition. Ajit Basu is of the view that tax dues of Dharma Private Limited cannot be recovered as he is no more a director. No more a director would not hold good. This argument would not hold good because he will have to pay the taxes. But if he can prove that it was not in his knowledge, he was not aware of this particular transaction, then that's fine. But argument that he is no more a director, that will not hold good, because at that particular point of time, when he was a director, he would be considered as under liability in certain cases. So his argument will not hold good in such cases. Obviously, he will have to jointly and severally owe the liability along with all the other directors. If it was a public company, then he wouldn't have been responsible, but private company, he will be responsible. Fine. Okay, then you have Raghuraman Private Limited, Pune, Maharashtra, provides housekeeping services. The company supplies services exclusively through e-commerce website. Owned and managed by TechnoSavvy Private Limited, Pune. The turnover of Raghuraman Private Limited is 18 lakh. Advise Raghuraman Private Limited as to whether it is required to obtain GST registration. People, 18 lakh turnover, that means you have not crossed the registration limit, because housekeeping services Maharashtra, the registration limit will be 20 lakh. That means you are not liable to register. And if you are not liable to register, for service industry supplying service up to this amount, you will not be required to register. Plus, the e-commerce website will be paying the tax under 9(5). So in that case, e-commerce operator is paying the tax under 9(5). As your turnover is 18 lakh, you are not liable to register. Will your advice be different if Raghuraman Private Limited sells ready-made garments exclusively through e-commerce website owned and managed by TechnoSavvy? If it is selling through e-commerce operators goods, then it is held up by section 24, compulsory registration. Then you will have to register, because you are selling through an e-commerce operator who is liable to collect tax on such transactions. So as TCS will be applicable, compulsory registration is required irrespective of any limit. You'll have to register from rupee 1. But services, housekeeping, 1 is not liable. Second, housekeeping services is covered by 9(5), where ECO will be responsible to pay the tax. Clear? Okay. Let's see the next one. Radhe Shyam is engaged in manufacture of goods in Rajasthan. It imported certain goods for use in the manufacture of the finished goods in the month of May. However, it did not clear the goods from the port for home consumption. Instead, it presented an into bond bill of entry on 14th May. Assessable value was $235,000. The order permitting deposit to warehouse for 4 months was issued on 21st May. People, this 21st May is an important date, because from the date you have got the order for depositing to warehouse, 90 days interest free period is allowed in warehousing. Again, this is related to a new chapter which has been added in your syllabus, warehousing in customs. Radheshyam deposited the goods in warehouse on the same day, but he did not clear the goods after the warehousing period got over on 21st September. A notice was issued under 72 demanding duty and interest. Radheshyam cleared the goods on 14th October. Custom duty paid on removal of goods was 8,28,000. See, 21st September deemed date of removal, but he cleared it on 14th October. That means interest will apply from 21st May to 14th October. First 90 days interest free period. You are required to compute interest payable on such removal, explaining the provisions of Customs Act, assuming that it is not a 100% EOU, software technology park, or electronic hardware technology park. Now 21st May to 14th October is what we have to compute. See, 21st May to 14th October. Let's count the days. May 10 days, June 30, July 31, August 31, September 30, October 14. Total comes to 122, 132, 146. Now out of 146 days, 90 days is interest free period. So interest will apply on 56 days. You can write the answer like this. The total number of days 146 days. 90 days no interest will apply. So interest will apply on 56 days. So 8,28,000. Because whatever is the duty payable, on that interest is applicable. 56 divided by 365. and the rate of interest is 15%. So if I do this computation, 8,28,000 into 56 divided by 365 into 15%, 8 lakh and this will come to 853, 19,055. This will be the interest payable. Correct? Yes. Okay, don't forget that in customs the interest rate is 15%. Okay, so you'll go with 19,055, which is the interest payable. They have asked us only interest payable, then don't give any other suggestion, deemed date of removal 21st September, etc. Nothing. 19,055 will be the interest payable. Clear? Okay. Let's see 18, 19, 20. Last 3 questions to go. 18. Lunar Technologies has imported a machine from its holding company in Japan on 25th Feb after paying custom duty of 38 lakh for use in its factory and re-exported on 10th October. You are required to advise duty drawback. See, 25th February, 10th October. Can I say it is falling under 6 to 9 month bracket? Because see, after use 0 to 3 months, you get 95% drawback. 3 to 6 months, you get 85% drawback. 6 to 9 months, you get 75% drawback. And this goes on till 18. 75% drawback is what is allowed. Now, 38 lakh into 75%. So the drawback which will be allowed will be 38 lakh into 75%, which comes to 28 lakh 50,000. This is the drawback which can be claimed for these goods. So you need to remember 0 to 3, 3 to 6, 6 to 9. First it reduces by 10%, then it reduces by 5%, and 15 to 18 months will be 60, which is the exemption score in IDT as well. That's how you can remember it easily, and you can write it like this as a rough work and give your final answer. Okay, the answer is not complete. Will your answer be different if it was X-ray films after using it? X-ray films after using it, no duty drawback will be allowed. Not even a single rupee duty drawback would be allowed. Okay, now 19. Let's see what is 19. Dhruv Tara Enterprises imported a machine from Japan for 48 lakh 75,000. However, the machine was exported back in June for repairs. The supplier had agreed to carry out repairs as it was still in warranty. Fair cost of repair 890. Since the repair process is expected to take 6 months, Dhruv Tara Enterprises requested the supplier to provide another machine so that they could use it. People, be very careful. Providing another machine, that means this fair cost of repair etc. is of no use. If another machine is coming, custom duty will apply on the entire amount. Correct? Let's see. According to the request, the supplier provided another machine and the FOB value of new machine was 49 lakh 50,000. Freight charges 1 lakh 80,000. Be careful. They have asked assessable value and total duty. Custom duty rate 10%, IGST 12, social welfare surcharge 10. GST cess and agriculture infra cess to be ignored. So they are asking us to determine the liability. Now, if you see carefully, what is missing is insurance. Be very careful. So FOB is given to you, that is 49 lakh 50,000. Freight is also given to you. I am sure we wouldn't have noticed one thing. It is through a vessel. Why is it important? Vessel, actual given, you can take actual freight, 1,80,000. And then insurance. Insurance is not given in the question, so we will take 1.125%. So 49,50,000 into 1.125%, which comes to 55,688. This is 1.125%. Now if I add 1,80,000 plus 49,50,000, then I get 51,85,688. Then people, 51,85,688, then it is simple, correct? Thereafter you'll have, this becomes your assessable value. Now basic custom duty at 10%, this will come to 51,85,669, 5,18,569, because this is 10% of this. Then you will charge SWS at 10% would come to 51857. Then comes IGST. So IGST will come to all three taken together, that is, I would just name it as A, B, C. So A plus B plus C into 12%. How much is that? 51,85,688 plus 518,569 plus 51,857 into 12%. 690,734. So the total custom duty payable would be this plus 51857 plus 518,569, 1261,160. This will be your final answer of custom duty payable. Clear? This will be your answer. Fairly simple question. What they want to trick us on is fair cost of repair, which will not be used in this case. That is used only when you are getting back the machine after repair. Then on that machine, fair cost of repair, to and fro, freight and insurance is liable. Okay. Last question, again a custom duty question. Let's have a look at it. Parshvanath Limited, engaged in supply of goods, imported certain raw material from Lumus Inc. of US. Lumus is controlled by Parshvanath, related person transaction. In the given case, the transaction value has been rejected because both are related. Okay. No similar or identical goods available as per rule 4 and 5. Fine. Parshvanath requests custom authorities to determine value according to rule 8, that is computed value, trying to determine the cost etc. and arriving at the value, and all the details of cost incurred etc. is given, because related person you will know what is the cost incurred. Custom authorities have the opinion that rule 7 value is available, that is 5,48,000 deductive value, so there is no need to apply rule 8. Is the request of Parshvanath legally tenable? The answer is yes. Rule 6 of custom valuation rules clearly provides that you can opt for computed value, you can request for computed value rather than deductive value. That's what they are doing in this. I don't see any harm in that. That's completely available. If so, compute the assessable value. Wonderful. It is tenable, so you'll have to compute the assessable value. Now, cost incurred by Lumus Inc. Cost of raw material, fabrication, other chargeable expenses, other indirect cost, normal net profit margin, 20% of FOB. So we'll have to reach till the cost and then find out the FOB. FOB is till the ship is in the export territory, free on board on the ship. Freight from Lumas INC to the US port, loading charges at US port, air freight. People, air freight. This was an exam question. They had, again, they'll mention port at one place and here it says air freight. What do I assume? Because it will make a difference. Obviously, it will make a difference whether it is air freight or it is through vessel. So, as the question is saying air freight, we will go with air, transportation of goods by air. So, the moment air freight is given to you, go by air freight rather than being with port. Sir, can we write an assumption? You can, but still I would recommend you to stick with the answers given by ICI. Air freight, even in an earlier question, when in an exam they had mentioned air freight, go by the answer related to air freight. So air freight will do that computation of 20%, and insurance from US port to Indian port, that will be at actuals. Then exchange rate $69. Let's start. See, raw material 2280, fabrication charges 1140, other chargeable expenses 456, then other indirect cost 285. See, freight till the goods reach the ship will have to be considered. So here 285 and 114 will also be added. All this will become cost so that I can derive my profit. So if I add all this, 2280, 1140, 456, 285, 285, 114. This comes to 4560. This is my cost up to port, correct? Up to the port till the goods reach the ship, this is the cost which I have incurred. Now the profit is given as 20% of FOB. See, 20% of FOB will mean 25% of cost. So I'll do 25% of cost. Now if I do 25% of cost, 4560 into 25%, which comes to 1140. Now I will get my FOB. My FOB will be 5700. Now 5700. Now what's air freight? Air freight will be, see, I'll have to consider all the three because freight adjustment will be 1710 plus 114 plus 285 or 20% of FOB. Now 20% of FOB or this all three taken together, whichever is lower. If I do this calculation, see, you can clearly see 1710, 114 and 285 is going to be much higher compared to 20% of FOB. So 5700 into 20% will come to 1140. Now, as we have considered 1140 as air freight, I will have to subtract freight and loading charges till the US airport. Freight and loading charges. Why are you excluding this, sir? Freight and loading charges, that is these two, 285 and 114. 285 and 114. I have considered these two here. 285 and 114 are already considered as part of 1140 whenever we are using a percentage. The moment we are using a percentage for deriving air freight, that means this 1140 already includes this 285 and 114. If I don't subtract it, then it will lead to a situation where I am paying custom duty on this twice. This is a benefit which government has given me. So 285 plus 114, I will have to deduct it here. So 285 plus 114. Now if I deduct 285 plus 114, this will come to $399. So $399 I will have to deduct because it is already considered as part of my 1140. This deduction you do only when a percentage is being used, whether air or vessel. But if you are using a percentage, then that percentage is already considered as including freight and loading charges up to the export port. So I subtract this. Add insurance because insurance will be taken at actuals, $57. Now if I do this computation, 5700 plus 1140 minus 399 plus 57, I get $6498. This will be my assessable value in dollars. I will have to convert it into INR. So 6498 into, what's the rate given? 69. At present though it is 77. Anyways, 69. So I multiply it with 69. I get 448,362 INR. So this will be considered as my value. A very good RTP, I would say, which covers different areas of ITC, prosecution, custom related adjustments, warehousing. Good coverage given in this RTP. I hope this video was helpful for you. Again, wishing you all the best for your exams on behalf of JK Shah classes. See you all. Take care.